Hello. In this session, I want to look at or give you feedback on Chapter 4 discussion. I just completed grading the discussion and I realized some of you missed most of the requirements for this assignment. The assignment had multiple elements to be completed, and most of you missed on item 5 and item 6. In item 5, you are required to uh, review the consolidated statement of operations and provide a narrative whether the company has been profitable in the last 3 years. And then in item 6, you are required to also look at consolidated balance sheet and compute, of course, the debt to assets ratio and see whether that number is more than 70% or is less than 70%. And of course, provide also a narrative how the company is doing. So let me take you to the statement of operations. Now, if you review the statement of operations, this is what we have: the consolidated statement of operations. And in this, again, our question was to look at how the farm was done, and therefore the best number for us to use is the net income number. I know some of you were providing a narrative that is based on gross profit. Others providing a narrative based on sales number. So sales number and gross profit does not tell us how well the farm is doing. So the number you are supposed to have used is, of course, the net income or loss number. So in 2018, you can see the company had a loss. So in 2018, the company had a loss. In 2017, the company had a net income, so there was a gain. And of course, in 2016, the company had a loss. So that's the only thing you are supposed to look at is the net income for 2018, 2017, and 2016, and provide a narrative based on what you see. And from this, you can tell the company had a loss in 2016, a loss in 2018, but there was a positive net income in 2017. And then the other part of the assignment was to look at the debt to assets ratio. Again, if I take you to the problem, I think it was confusing to some people, and I can tell you probably the issue that was confusing was where you're being asked to determine the total current and non-current liabilities to total assets for the past two periods, basically for the past 2 years. Now, if you think about it, the total current and non-current liabilities is basically referring to total liabilities, because the current liabilities are the short-term liabilities. The non-current liabilities are basically what we call the permanent liabilities. So to determine the debt to total assets, then we determine the total liabilities and then divide this into total assets, and that will give us the ratio that we are looking at. So again, if we go to the balance sheet, so we need to figure out where the balance sheet is. When we determine the balance sheet and we pick up the information from there, here is the balance sheet, and the balance sheet has the information that we are looking for. So in this, we need to figure out our total current liabilities. It's given to us. So your total current liabilities are given for 2018. It's given total current liabilities is given, and also it's also given for 2017. But in order for us to compute the ratio for each of the years, so you'll take the total current liabilities and add the current liabilities. And the non-current liabilities in this example is, of course, the long-term debt, the deferred taxes, and of course any other long-term liabilities. So you have to take your current liabilities, add on these other values, and this will give you your total liabilities. And then divide that number into your total assets. Your total assets you have is this. So if you divide the total liabilities with the total assets here, then that should give you your debt to assets ratio. So in other words, what we are trying to determine here is this: how much of those assets are being financed by debt, right? And in 2017, you'll do the same thing. You have your current liabilities here. You'll add other non-current liabilities, which you have that one, this value, and this value. And this again will give you total liabilities. And you divide this number into your total assets, and that will also give you the ratio that we are looking for. Then you compare, of course, the two ratios and see whether they're more than, of course, 70%. If so, I think it's a serious problem for the company, because it means most of the assets in the firm are being financed by debt. Now, some of you were giving me very interesting answers. Some of you are giving me a ratio of more than 100%. There's no way you can have that your assets are being financed by debt, and the debt, of course, is more than 100%. There's no way, because remember from what you have done in your previous chapter, the way we finance for the assets, this is something you have done in accounting. The way we finance for the assets is either through debt or equity. So in other words, this should represent 100%, which should finance for the assets. So you cannot have debt being more than 100%. That basically means it doesn't make no sense. And two, it then also means that the company doesn't have equity, which in this particular case, there is equity. The company has equity here. Again, you can see this equity there. And therefore, the assets are being financed both by liabilities, and they're also being financed by equity. So you cannot have debt representing more than 100%, because equity is also there. Even if equity wasn't there, then you can say debt is financing the assets, and therefore debt will represent 100%, but it cannot be more than 100%. I hope this information helps to clear out the discussion, chapter 4 discussion, and I hope moving forward, everything will be okay. Let me know if you have any questions. Otherwise, I'll see you next time. Thank you.